Hello, thanks for joining me today for this video. I'm going to get you to the analysis really quick, but I had to make a quick, important video today concerning the news that came out today, May 15th, about the Department of Justice looking into potential fraud by United Health Group considering their Medicaid practices. So here's why I am not going to change the analysis, but it's still important to talk about. So we all know that people react to the news. Sometimes they overreact for good reasons and for bad reasons. Whether positive or negative, the market overreacts and presents great buying opportunities. So the stock was already down 48% since April. Now we see that this Department of Justice potential probe is now dropped the stock just 10% alone today. So now the stock is at its lowest point that it's been over the past 5 years. And the reason why I'm still not going to change my analysis is because the Wall Street Journal put out an article, and it's a possible probe or probe into possible fraud. Now, this is according to people close to the situation. United Health Group said, hey, we have not received any news of a new probe. So they believe that this article by the Wall Street Journal is, as they stated, irresponsible. So they don't know if any probe is not official. Currently, just to give you some context, currently there are some investigations going on, but these are ongoing investigations, nothing new. United Health Group said they haven't received any news of anything new. As Wall Street Journal says, this probe is happening. But in March, the Department of Justice had a case that was dismissed against United Health Group because they failed to present enough evidence of any fraud. So it looks like the Department of Justice has been after this company, but they haven't been able to prove anything. So right now it's just news. It's not an official probe. There's no evidence of fraud that we're hearing yet. So I don't want to overreact to the news like the market is doing right now. Potentially nothing happens of this, and we have an even greater buying opportunity for United Health Group. So that's why I wanted to make this video, and also why I'm going to keep my analysis or evaluation the same and not change it as of yet. Once we have new facts and not just news, then we will update our opinions. But until then, we're going to stay prudent, stay patient, and we're not going to overreact to the market. So with that said, here's the analysis, and I thank you for joining me. All right, welcome back. We have another great stock to review today. My name is Carlos McCord, CPA. And on this channel, I love to review stocks and dig into them to see what stocks are quality and are investable and what stocks should we avoid. That's the whole point of my stock analysis. And I have one that I'm very excited to share with you today. It is United Health Group. Now, what's so special about this particular opportunity with United Health Group? So over the past few months, or year or so, they've had a lot of scrutiny. Once some political issues, of course, a lot of people are upset with the way healthcare is going in the United States and how expensive it is and how it seems to just benefit the corporations and not the people as much. So the healthcare industry is under a lot of scrutiny. One of the subsidiaries of this company, United Health Incorporated, the CEO was murdered by someone, a vigilante, and a lot of people were not celebrating the death. At the same time, we weren't very surprised because the way these health companies are treating the patients and treating the population. So that was one thing that happened a little while back. Recently, the CEO has stepped down, and that's caused some uproar. Typically, as the number one leader in the space when it comes to healthcare, they've delayed putting out their guidance recently. I think part of it is with the CEO shakeup. And so we have a company that is the leader in healthcare. They are changing their CEO. The stock is down 48% over the past few months. So that creates a potential great opportunity. If you watch anything that I put out as far as my stock analysis, you know I love to value invest. I love to look at great opportunity. And when stocks fall sharply very quickly, that signals a potential buying opportunity, especially when you're talking about an industry leader. So we have to take a dive into this business to see what's going on. So let's take a quick look at United Health Group. So this business is right now trading at $308.01. Today is May 14th. Now look at the chart. Over the past 5 years, this stock is only up 6% from their 5-year mark 5 years ago. So we're going to remember that 5 years, the stock has gone up and come back down. Looks like it's still another great buying opportunity just off of the chart with this sharp decline here. But we'll take a deeper dive and see do we think this is a good price to get in at? Market cap is 279 billion right now, a beta of 0.57. So this stock does not have a lot of volatility, and the price earnings ratio of 12.9. We see a dividend of 2.7%. So that's solid dividend right there. So let's get into the numbers real quick. Looking at the revenues, 2015, we have this company being at $157 billion, all the way up to 407, trending for the past 12 months, ending 2024 at $400,000. We see that this, $400 billion, excuse me. So we see some single digit growth this past year, 8.9 in 2020 and 2019. But for the most part, we have double digit growth. They're averaging about 10 or 11% growth rate over the past 10 years. So that's a medium growth state. So a company who's number one in their space growing at a double digit growth on average is really solid. So we like to see that. Looking at the margins, 23%, pretty solid, staying at 23%, coming down at 22 and 21 over the past 12 months. So to see some decline here, not an alarming amount or a decrease that's alarming. We have a minus 3% here. Not a big deal, just looking at the overall picture of the numbers, but we do know that there could be some margin restriction or pressure adding to some costs, pushing the margins down a little bit there. But overall, not a bad picture when we're looking at margins and the revenue growth. So let's take it net income. First thing I like to look at, how many years of negative growth. So they've had a down year this past year of down 35%. So this could be one of the reasons why the stock is down so sharp. We have $5.8 billion going to 14.4. Oh, but the trailing 12 months, looking at the first quarter of this year plus the 3 quarters of last year, we're at $22.1 billion. So it looks like we have a sharp growth here, almost on par with where we are in 2023. So down a little bit last year, but looks like we're picking right back up and continuing the strong trend. So we're averaging 11.3% over the past 10 years, 3% over the past 5 years. Net profit margin, 3.7 up to 6 and coming back down to 3.6. So again, a little bit like the gross margins, we're seeing some increase, but maybe a sharp decrease here. But again, bouncing back over the 12-month trend. So not really alarmed at 1 year of down performance. You're going to see this from time to time when a business is the number one. When you're at the top, it's really hard to continue to grow at a fast rate and have consistent growing years every year, especially when you're talking about healthcare. It's not a new industry. It's a very established industry. So this is expected from not necessarily an up-and-comer, but you should expect this from the company that is at the top of the mountain. So looking at their free cash flow, I expect to see some similarities. All right, so we have a growth rate past 3 years of 2.7, so very modest. Past 5 years of 5.9%. Let's look at the negative years. 1, 2, 3 down years of free cash flow growth. However, similar to the net profit, we have this down year, but it seems like they're picking it right back up and getting on their trend of pretty modest growth, I'd say still. But nevertheless, they're still growing their free cash flow. So we're going to keep that in mind as we look at the dividends later on. But let's take a quick look at their debt. Looking at their debt, 2015, $25.4 billion up to 72.3. So growth there. They have a debt to free cash flow ratio right now, 3.5. We want to see this ideally below 3. If we will accept below 5, we want a company to be able to pay off their debt in 5 years or less, ideally 3 years or less. So averaging about 2.5 years for the past 5 years. So they can pay off their debt on average in 2.5 years. Solid position to be in. They maintain great leverage on their balance sheet when it comes to their cash flow and comparing that to their debt levels. So that is solid here. Now, this is what I got excited about here. So right now they're paying a dividend Let me adjust this real quick. Dividend of 2.72%. Pretty solid. $2.10 per quarter. And here's what I love. 36% of their free cash flow. That means after they paid all of their expenses and covered the required reinvestment back into the business, the amount of cash that's left over, 36% of that is going out to a dividend, is going out to the shareholders in the form of a dividend. So we have 36.4% there, which means they have a lot of room to grow that dividend. Now let's look at this company's growth rate. So 11.7% growth on their dividend, 13.9, 13.7, 16, 15.7, 20%. Let's keep going. We have another 20%, another 20%, 25, 33. So if you think about this past 12 years, if you've bought this stock and held it, that dividend has grown at double-digit growth every year. So if you had the stock since then, congratulations, you found a great dividend growth stock. And I love dividend growth investing. I think as far as people who got a late start to investing, these are the type of stocks you need. I understand you want the NVIDIAs, you want the super popular stocks. I get it. However, these are the ones that create wealth just the same or even better than some of those stocks because they're less volatile and they're growing that income every year. So imagine getting a 15% raise at the job every year, or a 16 or 20% raise on your job every year. Most people don't get that through their jobs, but you can get that through dividend income. This is why I love these dividend growth stocks. So this double-digit consistent growth is likely to continue based on the fact that this company is the number one in their space and they're only paying out 36% of their free cash flow in dividends. That means they can continue to grow this for a long time. And it looks like they're committed to that high growth because that's what they've been doing over the past 10 to 15 years. So keep this in mind and keep an eye on this stock for this reason alone. But of course, we're looking at the other metrics and everything looks pretty good so far. This is icing on the cake. And for those that are getting a late start to investing, these dividend growth stocks like United Health Group, these are the stocks you need to be interested in because think about getting this free money that you reinvest into the business every year, compounding your growth in multiple ways. The stock is growing, the dividend is growing, and you're reinvesting the dividends, buying more stocks for free, which means you're getting more dividends in the future off of that. So this is the focus that you need to have if you're getting a late start to investing. Shares outstanding. We look at this because we want businesses to be able to take extra cash, of course, pay it back to the shareholders in a dividend, and or buy back shares. As they reduce the share count, the remaining shares become more valuable because they own more and more and more of the business. And that's exactly what they've been doing over the past few years. Every year, they're buying shares and reducing the share count by a lot. This past year, it went up a little bit. So I do want you to see that. A slight increase, not alarming, but the strong downtrend over the past few years. If you held this stock and they're continuing to buy shares, so what that they have this small little uptick in this past year? You're not worried about that. On top of the fact that you're getting a dividend that's growing at a very high rate, this is minimal, nothing to worry about. Shares outstanding coming down at this rate looks amazing and what you should expect from a mature company like this. So now let's look at value added. I like to look at the return on capital and compare that to the weighted average cost of capital. How much money do you have available to invest into your business? Whether you invest it or not, it's available for you to invest. Management has to make the decision on how much capital to put into the business to create a return. So I want to know how effective is management. So I'm going to look at the returns on capital, compare that to the cost of capital. If you have cash ready to, or capital to spend on your business, that comes with the cost, whether it's debt and you have interest, or whether it's just the opportunity cost. Of course, you can take that money and put it in treasuries or put it into the stock market. But if you're going to put it into your business, then what is the opportunity cost? So we want to look at all of those factors to determine the weighted average cost of capital and compare that to the returns on capital to see how effective is management. And right now, it looks like they're doing a great job. We got a 17.7% of return on capital compared to a very low cost of capital of 4.53%. That means this company is averaging about 13% of value creation based on their capital balance, or based on the capital that they have, 13% per year over the past 5 years. So we see they have a great spread, and year over year, they're creating value. We like to see that. So far, this company is looking pretty solid, pretty what you would want to see in a very mature company and a business that is leading the pack. Solid revenue growth for their state. Dividends growing at an amazing rate. They're buying back shares. They're keeping a healthy balance sheet. They have great leverage. They can pay off their debt fairly quickly. So everything's looking good so far, in my opinion. So let's look at the valuation. So the growth rate right now is averaged or expected to be about 11% over the next 5 years. We compare that with a discount rate of 10%. They have a cost of capital of only 4% or 4.5. So we're going to add a little bit of risk premium in there to get to that 10%. We expect to get 15 times free cash flow as far as the valuation if we were to sell the stock in 5 years. Just for reference, right now they're trading at 13.5%. They're trading below their average, but their average over the past 20 years is about 15%. So this is a very popular business, a quality company. I expect to at least get the average of free cash flow, or price times free cash flow, at least 15 times the average amount if I were to sell the stock in 5 years. So with that said, with the stock trading at about $308, I believe the intrinsic value is somewhere around $516, giving you a potential upside of approximately 67%. This stock is definitely undervalued. By how much, I'm not exactly sure. My range is about between 490 and 542. So why am I giving you a price, giving you a percentage of a potential upside, giving you a range and saying, that I think this is a roundabout? Because the whole point of doing a valuation is not to be exact. This is not a science, it's more of an art. So understanding that, yes, my math is going to give me a number, but I know I'm going to think of it more of a range than an exact number because I could be wrong. Also, the whole point is to be directionally right, not to be exact, but if I have a quality business, I want to know, is it overvalued, fairly valued, or undervalued? So I use this metrics and this math and discount cash flows and these inputs to kind of figure out, am I in the ballpark, or what do I think about the stock? And this is just where I think. So I think the range is between 490 and 542. So I think this stock is definitely well under the low end of the fair value range. So you got definitely lots of potential growth. Now, you were to go buy the stock today, I'm not saying that this stock is not going to go down some more. They're on a significant downtrend. There's some uncertainty going on. One thing that might give some people some ease over their heartburn, they did change out their CEOs, but the CEO that's coming in is currently the board chairman and was the CEO of the company about 10 years ago. So this is someone who's very familiar with the business and has stayed connected with the business since they left that CEO seat. They're back in it now. So we'll see how that plays out. That's typically a good sign. Someone who's definitely vested into the company and again, been connected with the company this whole time. So whatever troubled waters that they're facing, this person is well aware of it and knows the business very well. Otherwise, they wouldn't have been the CEO before. So that should give some people some ease over their heartburn. But again, this is an industry leader. Giants do fall, but they don't fall often. Typically, when a company is this strong and this balanced and has such a spread over the number two, such a gap between them and the number two player, when they experience these things, people sell off. They sell the stock because they don't like the news. But this company has the runway to get back on track very easily and continue to hold that number one stock. Again, this is a Dow 30 stock. This is an S&P 500 stock. You've seen what they're doing with their dividend. I don't think too many shareholders are going to leave. But hey, 58% drop means it's potentially a great opportunity for me and you. So this is definitely one to put on your watch list if you're not ready to invest in this stock yet. If you need exposure, if you're looking for exposure to the healthcare industry, I would say this is one that you should be interested in for those reasons. So one thing that you have to understand when it comes to stock movements, this is one thing that I always keep in mind. This company, let me look at a year-to-date chart. This company dropped about 48%. I'm absolutely sure that they did not get 48% worse during these past few months. You may say, hey, this company was not worth this much, so this is a better valuation. However you want to look at it, they didn't get 48% worse in a few months. If anything, with the change in the CEO, maybe they got better. So if you were willing to buy this stock at any time over the past 5 years, now is a good time to buy when comparing the current price to that. So again, we're about 6% off of the mark where it was 5 years ago. Looks like a great buying opportunity. So that's my thoughts on United Health Group. Definitely solid dividend. Again, great balance sheet. Continuing to grow on the revenue side. I'd say it's positive growth. If a company is in double-digit growth and they're this old, this mature, that's a good sign. Typically, these mature companies, we can expect 2%, 5%, 7%, and that's pretty solid for a company that's mature. This is a mature company that's growing at over 10% per year on the revenue side. So that's a good sign. These are my thoughts of the business. I hope you enjoyed this analysis. Let me know what you think about this company in the comments, and I hope to see you in the next video.